Over the weekend, Credit Suisse, one of the world's largest and most important banks, ceased to exist. Just before that, SVB and Signature Bank, both in the US, have had quite a difficult time of things. Why has this happened? Well, I'm afraid we have to start from the beginning, and the very beginning is, what is money? Well, ask any child and they'll tell you it looks something like this. And they'd be absolutely right. This is definitely money. Psychologically, though, we hold one of these and we imagine all the things it'll buy. What inflation does is reduce the value of those things or increase the price of those things, which is the same thing. Your 20 euro or 20 pound note buys a bit less of the same stuff next year than it does right now. But what happens if I take this money and deposit it in a bank account? Does that money still exist? And the answer is in many ways no. The answer is that when a person deposits money in a bank, most of it ceases to exist forever. The morning after Halloween, I take a big cardboard box and I ask 5 children for one of their bags of 20 M&Ms. Put the bags in the box and I'll give you one more M&M for every year. Don't worry if you want your bag of M&Ms back, I have them right here. But if you all come back and want your M&Ms back, I don't have them. I won't have them. Well, the first thing I'd want to know as a child is, what are you going to be doing with these M&Ms? Where are they going to be? Why can't we get them all back? And that's a very good question, because banks are weird. In one part, they're essential utilities like electricity or water, because in the modern day, we need a bank account to fulfill simple functions. But the other part is that they're casinos gambling their money, or your money, and trying to make a profit in the capital markets in a way that doesn't happen at the water company. And that's why many countries will guarantee or insure the deposit up to a certain amount, perhaps 80,000 euros or $250,000, as is the case with the US. So maybe we can expand our definition of money to at least include the parts of the deposit that are insured by the same people who give these little pieces of paper value in the first place. But what about the rest of it? What about if I, as a business owner, need to keep $1 million of cash on hand to pay things like office rent and wages? I think the government might frown or even object if I did that in cash. So we can say that I need a bank account. For me, the bank account is a utility as much as getting the internet or a gas hookup for a water heater. But when I get that gas hookup, one of the things that I don't think about and don't think I should have to think about is the likelihood of the gas main down the street exploding. That's due diligence I don't think I should have to do. So you can say that I do have some sympathy with the clients of SVB who were made whole again by the US government and US taxpayers, even above their insured deposits. So again, we've established one or two definitions of money. It's definitely cash, and it's definitely bank deposits if they're insured by the state, but maybe we can say that it should be all bank deposits, but normally isn't. But here is something that money isn't: wealth. Now, on the individual level, we can say that if I have $10 million, I am wealthy and I can buy a house which costs $10 million. But what the $10 million actually equates to is a fraction of the total wealth in an economy. And what that fraction is the share of all the money in the economy that the $10 million represents. And what that means is that the more money that's in the economy, the less each unit of money, in this case a dollar, is actually worth. And it is this increase in the supply of money, or printing money, that is one of the most immediate causes of inflation. But the wealth of a nation is created by people getting up in the morning and going to work, and thus creating wealth. And during the pandemic, a lot of people stayed home and didn't do that. And the wealth that they would have created was lost forever. Now, governments and central banks can't do anything about that, but they can, through the use of financial mechanics, spread the impact of that loss of wealth over a larger period of time, so that people are less likely to starve or go bankrupt from not working for a couple of months. And they do this by printing money or creating money and giving it to people to spend. And through the resulting inflation, they're going to be a bit poorer, but for much longer. But printing money isn't the only cause of inflation. Inflation has the tendency to run away with itself. As prices increase, so salaries need to increase, so that the workers can then afford to buy the products at the higher prices, but that increases the costs of the products, and prices need to increase again. And so what a central bank does is increase interest rates to encourage people to put their money into the bank rather than spend it. And that has a cooling effect on inflation. Now, as we said before, when you deposit your money in the bank tries to make a profit on it and will invest the money. A lot of the money often goes into very safe investments like US Treasury bonds, things like that. A US Treasury bond is a piece of paper from the United States saying that in a certain amount of time, you're going to get your money back, and at certain intervals, you'll get an interest payment as well, which in bond language is called a coupon. Now, when inflation and interest rates were low, the coupons the US offered on its bonds were also quite low. New bonds issued now will have a much higher coupon, so the old bonds are worth less than they started out at. And that's still fine, because you can just hold on to them to collect your coupon payments and wait till maturity, where you'll get all the money you started out at back. Except if you're SVB and all of your clients want their money back immediately, then you might have to sell those bonds to pay your clients. And when your bonds aren't worth what they were, then you have a problem. But this isn't all inevitable. The major problem with SVB and Signature Bank was that they didn't diversify their investments enough. And also they didn't diversify their client base. What do I mean by that? Well, long-dated bonds, or bonds that will pay your money back in the more distant future, pay normally a higher coupon or interest rate than short-dated bonds. The same way you get a better interest rate if you tie your money up in the bank for 2 years rather than an instant access bank account. So in spite of really quite clear signals from the central bank, the Fed, that interest rates were going to rise, SVB didn't want to purchase more short-dated bonds that would have provided it with less profit, but the liquidity it would have needed to pay depositors back. Both SVB and Signature Bank also had very tightly knit and similar clients. They were diversified. In the case of SVB, they were part of Silicon Valley, and in the case of Signature Bank, there were a lot of young metropolitan Bitcoin investors, and those things make a bank run that much more likely. Now, Credit Suisse certainly suffered from increased interest rates in a very similar way, but had been loss-making and badly run for a long period of time, and it's generally a far larger and more complex bank. So the Swiss National Bank and UBS got together and quickly made arrangements for UBS to take over Credit Suisse, and they did it over the weekend, which is the only time you can really do it. You can't do it while the markets are open because people will panic, and you can't do it during the night on a weekday because there isn't enough time. So by Monday morning, they had the announcement that most people wanted to hear. Now, the last time this sort of thing happened, 2008, a number of banks got stung by buying failing banks, essentially because they were worth significantly less than they originally thought. So the national bank, the central bank, usually has to guarantee a certain amount of money. The Swiss National Bank, in this case, in the case that UBS finds problems on the Credit Suisse balance sheet later on. So that's what happened with banks over the last week in a nutshell. Credit Suisse was one of 30 global banks deemed too big to fail, but what's happened is Switzerland has been left with just one bank, and although it's doing really well, its failure would be roughly twice as bad now than before. And I'll leave you on that sunny note until next time.